This presentation is for Accounting 221, Accounting Principles 1, Chapter 3, The Adjusting Process. These are the first three learning objectives for Chapter 3 to differentiate between cash basis accounting and accrual basis accounting, to define and apply the time period concept, revenue recognition and matching principles, and to explain the purpose of and journalize and post adjusting entries. The next two learning objectives for Chapter 3 are to explain the purpose of and prepare an adjusted trial balance and to identify the impact of adjusting entries on the financial statements. The last two learning objectives are to explain the purpose of a worksheet and use it to prepare adjusting entries and the adjusted trial balance, and to understand the alternative treatments of recording deferred expenses and deferred revenues. In the first section, we will learn to differentiate between cash basis accounting and accrual basis accounting. There are two ways to record transactions: cash basis accounting and accrual basis accounting. Cash basis records transactions based upon the receipt or payment of cash. Under cash basis, revenues are recorded only when cash is received, and expenses are recorded only when cash payments are made. Accrual basis records the effect of each transaction as it occurs, when revenues are earned and expenses are incurred. Therefore, revenue is recognized when the service is performed, not when the cash payment is received, as the receipt of cash may occur at a later date. Accrual basis accounting is required by generally accepted accounting principles, or GAAP. Cash basis accounting is not allowed under GAAP. Suppose on May 1st, Smart Touch Learning paid $1,200 for insurance for the next 6 months, $200 per month. This prepayment represents insurance coverage for May through October. Under the cash basis method, Smart Touch Learning would record insurance expense of $1,200 on May 1. This is because the cash basis method records an expense when cash is paid. Accrual basis accounting requires the company to prorate the expense. Smart Touch Learning would record a $200 expense every month from May through October. Suppose on April 30th, Smart Touch Learning received $600 for services to be performed for the next 6 months, May through October. Under the cash basis method, Smart Touch Learning would record $600 of revenue when the cash is received on April 30th. The accrual basis method, though, requires the revenue to be recorded only when it is earned. Smart Touch Learning would record $100 of revenue each month for the next 6 months beginning in May. Under both methods, cash basis and accrual basis, the total amount of revenues and expenses recorded by October 31 was the same. The major difference between a cash basis accounting system and an accrual basis accounting system is the timing of recording the revenue or expense. In the second section, we will define and apply the time period concept, revenue recognition, and matching principles. The time period concept simply states that a business's activities can be sliced into small time segments, such as months, quarters, or years. Typically, a company's fiscal year spans a period of 12 months. A calendar year is a fiscal year that begins on January 1 and ends on December 31. Many companies begin their fiscal year at the beginning of a quarter following a slow period. For example, retail organizations such as Walmart, JCPenney, Target, etc. may have a fiscal year from February 1 to January 31, since January is a slow month following the holiday season. Step 1 of the revenue recognition principle is to identify the contract with the customer. A contract is an agreement between two or more parties that creates enforceable rights and obligations. In Step 2, identify the performance obligations in the contract. A performance obligation is a contractual promise with a customer to transfer a distinct good or service. A contract might have multiple performance obligations. For example, AT&T Inc. often provides a new phone to customers who sign a 2-year cellular service agreement. This represents two distinct performance obligations. the cellular service agreement, and the new phone. In step 3, determine the transaction price. The transaction price is the amount that the entity expects to be entitled to as a result of transferring goods or services to the customer. In step 4, allocate the transaction price to the performance obligations in the contract. If the transaction has multiple performance obligations, the transaction price will need to be allocated among the different performance obligations. Step 5, recognize revenue when or as the entity satisfies each performance obligation. The business will recognize revenue when or as it satisfies each performance obligation by transferring a good or service to a customer. A good or service is considered transferred when the customer obtains control of the good or service. The amount of revenue recognized is the amount allocated to the satisfied performance obligation. The matching principle, sometimes called the expense recognition principle, guides accounting for expenses and ensures that all expenses are recorded when they are incurred during the period and expenses are matched against the revenues of the period. To match expenses against revenues means to subtract expenses incurred during one month from revenues earned during that same month. The goal is to compute an accurate net income or net loss for the time period. Some expenses are easily linked to revenues. For example, Smart Touch Learning pays a commission to the employee who sells the e-learning company's services. The commission expense is directly related to the e-learning company's revenue earned. Other expenses are not so easy to link to revenues. For example, Smart Touch Learning's monthly rent expense occurs regardless of the revenues earned that month. The matching principle tells us to identify those expenses with a particular period, such as a month or a year, when the related revenue occurred. The business will record rent expense each month based on the rental agreement. After this section, you should be able to explain the purpose of and journalize and post adjusting entries. The end-of-period process begins with the trial balance. The unadjusted trial balance is incomplete because it omits various revenue and expense transactions in the account balances. Accrual basis accounting requires the business to review the unadjusted trial balance and determine whether any additional revenues and expenses need to be recorded. Are there revenues that Smart Touch Learning has earned that haven't been recorded yet? Are there expenses that have occurred that haven't been journalized? Adjustments are needed to properly measure several items, such as 1. Net income or loss on the income statement, and 2. Assets and liabilities on the balance sheet. There are 2 basic categories of adjusting entries: deferrals and accruals. In a deferral adjustment, the cash payment occurs before an expense is incurred, or the cash receipt occurs before the revenue is earned. Deferrals defer the recognition of revenue or expense to a date after the cash is received or paid. Accrual adjustments are the opposite. An accrual records an expense before the cash is paid, or it records the revenue before the cash is received. A deferred expense is an item paid for in advance by the company for use in the future. Such payments are considered assets rather than expenses until they are used up. When the prepayment is used up, the used portion of the asset becomes an expense via an adjusting entry. In Transaction 10 in Chapter 2, Smart Touch Learning prepaid for 3 months office rent of $3,000, $1,000 per month times 3 months, on December 1st. After posting, prepaid rent has a $3,000 debit balance. As of December 31, prepaid rent should be decreased for the amount that has been used up. The used up portion is 1 month of the 3 months prepaid, or 1/3 of the prepayment. Recall that an asset that has expired is an expense. The adjusting entry transfers $1,000, $3,000 times 1/3, from prepaid rent to rent expense. Prepaid rent is an example of an asset that was overstated prior to journalizing and posting the adjusting entry. The December 31 unadjusted trial balance for Smart Touch Learning shows a balance in office supplies of $500. This represents the amount of office supplies that were purchased earlier in the period. Assume the ending balance of supplies is $100, which was found by counting the office supplies on hand at the end of the month. Since there are only $100 of supplies left on hand, the company has used $400 worth of supplies, found by taking $500 beginning balance minus the $100 ending balance. This would mean that the current office supplies balance of $500 is no longer a fair representation of the amount of office supplies that Smart Touch Learning currently owns. Therefore, the adjusting journal entry is needed to properly report the correct balance of office supplies on the balance sheet. The December 31 adjusting entry updates office supplies and records supplies expense for November and December. After posting the adjusting entry, the December 31 balance of office supplies is correctly reflected as $100, and the supplies expense is correctly reflected as $400. The office supplies account then enters January with a $100 balance. If the adjusting entry for office supplies had not been recorded, the asset would have been overstated and supplies expense would have been understated. Most prepaid adjusting journal entries are related to the adjustment of a current asset account. However, long-lived tangible assets are also used in the operations of the business. They act much like other prepaid assets, except adjustments will be made to the plant assets over a number of years instead of 1 or 2 years through depreciation expense. Depreciation is a type of prepaid expense adjustment. Plant assets are recorded in full at the time of purchase. Therefore, an adjustment is recorded to reduce the value of the asset over its useful life. The prepaid adjustment for plant assets is called depreciation. The expected value of a depreciable asset at the end of its useful life is called the residual value. The straight line method allocates an equal amount of depreciation each year and is calculated as cost minus residual value divided by useful life. In Chapter 2, on December 2nd, Smart Touch Learning received a contribution of furniture having a market value of $18,000 from a stockholder. The original entry included a debit to the furniture account on the balance sheet and a credit to the common stock account. Notice that in the above adjusting entry for depreciation, we credited accumulated depreciation furniture and not the asset account furniture. Why? We need to keep the original cost of the furniture separate from the accumulated depreciation because of the cost principle. Managers can then refer to the furniture account to see how much the asset originally cost. This information may help decide how much to sell the asset for in the future or how much to pay for new furniture. The accumulated depreciation account accumulates the depreciation expense. This means that next month an additional $300 will be added to the accumulated depreciation furniture account, creating a balance of $600, representing 2 months of depreciation. At the end of 3 months, the accumulated depreciation furniture account will have a balance of $900, $300 per month, times 3 months. A business may have a separate accumulated depreciation account for each depreciable asset. However, small companies often have only one accumulated depreciation account for all of their depreciable assets. Accumulated depreciation furniture is the contra account that follows the furniture account on the balance sheet. The furniture account has a normal debit balance, so accumulated depreciation furniture, a contra asset, has a normal credit balance. The balance sheet reports both furniture and accumulated depreciation furniture. Because it is a contra account, accumulated depreciation furniture is subtracted from furniture. The resulting net amount, cost minus accumulated depreciation of a plant asset, is called its book value. The book value represents the cost invested in the asset that the business has not yet expensed. Suppose that Smart Touch Learning purchased a building on December 1st. The monthly depreciation is $250. The adjusting entry would record depreciation for December by debiting depreciation expense building and crediting accumulated depreciation building for $250. Had Smart Touch Learning not recorded the adjusting entries for depreciation on the furniture and building, plant assets would have been overstated and expenses would have been understated. After recording the adjusting entries, plant assets are reported at the correct net amount, as shown on the December 31 partial balance sheet in Exhibit 3.2. The cost principle requires the plant asset account to maintain the cost value in the asset account. However, the corresponding contra account is reported in the assets section of the balance sheet. The plant asset and corresponding accumulated depreciation accounts are netted so that the depreciated value, book value of the asset is reported properly in the assets section of the balance sheet. Deferred revenues occur when a company receives cash from a customer prior to performing services or delivering a product. For example, an attorney requires a new client to pay a retainer fee of $1,000, yet no services have been performed. The attorney debits cash and credits unearned revenue to establish the liability. If the client decides to not use the attorney, he or she can request a refund. Upon performance of the service, the revenue will be recognized. Deferred revenues arise when the company receives payment from a customer prior to services being performed or products being delivered. Since the company has not yet performed the service or delivered the product, the customer has a right to request a refund. Therefore, the company still owes the customer either performance or money back. Therefore, a prepayment from a customer is considered a liability. On December 21, a law firm engages Smart Touch Learning to provide e-learning services for the next 30 days, paying $600 in advance. Cash is debited for $600 and unearned revenue is credited for $600. During the last 10 days of the month, December 22nd through December 31st, Smart Touch Learning will earn approximately 1/3, 10 days divided by 30 days, of the $600, or $200. Therefore, Smart Touch Learning makes an adjusting entry to record earning $200 of revenue. This adjusting entry shifts $200 from the liability account to the revenue account. Service revenue increases by $200 and unearned revenue decreases by $200. Had the adjusting entry not been made, the liability unearned revenue would be overstated and service revenue would be understated. Businesses often incur expenses prior to paying for them. An accrued expense hasn't been paid for yet. A great example is salaries expense. Employees work for a period of time before the business pays them for their time. This is an example of receiving a service prior to providing payment. Assume that Smart Touch Learning normally pays its employees a monthly salary of $2,400. Smart Touch Learning typically pays half the salary on the 15th of the month and the remainder on the first day of the next month. On December 31st, Smart Touch Learning will need to recognize that it owes its employee for 1/2 month of salary, or $1,200. During December, the company paid the first half-month salary on Thursday, December 15th. The entry debits salaries expense and credits cash for $1,200. The December 15 entry records only the first half of December's salaries expense. The second payment of $1,200 will occur on January 1st. However, the expense was incurred in December, so the expense must be recorded in December. The adjusting entry to record salaries accrued during the month of December is a debit to salaries expense and a credit to salaries payable of $1,200, found by taking the monthly salary of $2,400 and dividing it by 2 pay periods. The accrual is necessary because the company has incurred the expense since the employee has performed the work. When the payment is made on January 1, the salaries payable account will be debited, effectively eliminating the liability, and cash will be credited. This is an example of a liability that was understated before the adjusting entry was made. It also is an example of the matching principle. We are recording December salaries expense in December so that it will be reported on the same income statement as December's revenues. Don't confuse this entry with an adjusting entry. Adjusting entries are recorded only at the end of the accounting period and are used to record either revenue earned or expenses incurred. This entry is a journal entry. It is simply recording an everyday business transaction, the payment of salaries previously accrued. In this example, the amount paid for salaries was equal to the amount of the liability in the adjusting entry. Companies often borrow money for purchase of equipment or buildings. The interest on the loan could be paid monthly, quarterly, or annually. Regardless of when the interest expense is actually paid, a business must accrue the interest expense owed but not yet paid each month. The entry to record accrued interest is a debit to interest expense and a credit to interest payable. When the interest is paid, interest payable will be debited and cash will be credited. The above example illustrates the following. On December 1, Smart Touch Learning purchased a $60,000 building in exchange for a one-year loan. Interest on this note is payable 1 year later on December 1, 2019. Although the company won't make the interest payment for a year, the company must record the amount of interest expense that has been incurred by December 31, 2018. The company will make an adjusting entry to record interest expense for 1 month. Assume 1 month's interest expense on this note is $100. The company will make an adjusting entry to record interest expense for 1 month, December 1st through December 31st. Assume 1 month's interest expense on this note is $100. The adjusting entry records a credit to the liability interest payable. This is because the interest payment will not be made until next year. Therefore, Smart Touch Learning owes interest to the bank. Had the adjusting entry not been recorded, liabilities and expenses would have been understated. Accrued revenue occurs when a company earns revenue, usually as a result of performing services or delivering products to a customer before receiving payment. If the revenue has been earned, it is recorded even if payment has not been received from the customer. Accrued revenue entries generally require a debit to the customer's accounts receivable and a credit to a revenue account. Smart Touch Learning is hired on December 15th to perform e-learning services beginning on December 16th. Under this agreement, the business will earn $1,600 monthly and receive payment on January 15th. At the date of hiring, Smart Touch Learning does not record a journal entry because revenue has not yet been earned. During December, it will earn half a month's fee, $800 for work December 16th through December 31. The adjusting entry records the earned revenue and brings the balance of the service revenue account to $17,500. In addition, the adjusting entry records an additional $800 account receivable. Smart Touch Learning did not record cash because the business has not yet received payment on the services provided. The cash will not be received until January 15th. Without the adjustment, Smart Touch Learning's financial statements would understate both an asset, accounts receivable, and a revenue, service revenue. The adjusting entry on December 31 records revenue earned for half a month and also creates an account receivable. When Smart Touch Learning receives the payment on January 15th, the business will record cash received. Notice that on January 15th, Smart Touch Learning records revenue only for the remaining half of the month, January 1st through January 15th. Smart Touch Learning recognizes that $800 of revenue was already recorded in December. The entry on January 15th removes the accounts receivable and records the remaining revenue. If the business had incorrectly recorded $1,600 of service revenue on January 15th, the revenue would have been overstated in January. Exhibit 3.3 is a summary of the deferral and accrual adjusting entries. The original entry and the corresponding adjusting entry is shown for the deferral adjustments. For example, the asset account prepaid rent is a debit and cash is the credit in the original entry. When the rent is used, the prepaid rent account is adjusted with a credit, which decreases the value of the asset. A debit to rent expense captures the usage of the building. Accrual entries do not have an original entry. They are adjustments for revenues earned but not yet collected and expenses incurred but not yet paid. Adjustments to the unadjusted trial balance are accomplished using adjusting entries. Mechanically, adjusting entries are similar to other journal entries. First, the accounts to be adjusted are identified. Then a determination is made as to whether to debit or credit each account. Then the adjusting entry is credited and posted to the general ledger. Exhibit 3.4 is a summary of the adjusting entries discussed throughout the chapter. Entries A through D are examples of deferred expenses. Item E is a deferred revenue adjustment. Entries F and G are accrued expenses, and entry H is an accrued revenue adjustment. After this section, you should be able to explain the purpose of and prepare an adjusted trial balance. The adjusted trial balance includes all of the adjusting journal entries associated with deferred expenses, deferred revenues, accrued expenses, and accrued revenues. The purpose of the adjusted trial balance is to ensure the debits and credits are equal. Even if the debits are equal to the credits, there could still be potential errors in the journaling or posting processes. The adjusted trial balance is used to create the financial statements prior to the closing process. The debits are equal to the credits in the adjusted trial balance, which is similar to the unadjusted trial balance discussed in Chapter 2. The information from the adjusted trial balance is used to create the financial statements in the following order: income statement, statement of retained earnings, and the balance sheet. The adjusted trial balance for Smart Touch Learning is shown in Exhibit 3.5. After this section, you should be able to identify the impact of adjusting entries on the financial statements. Failure to record the adjusting entries results in inaccurate financial statements. For example, if the adjustment for a deferred expense is not made, the asset account will be overstated and the expense account understated. This type of error results in an overstatement of net income because the expenses are too low. A summary of the impact on the financial statements is shown in Exhibit 3.6 on the next slide. The adjusting journal entries are absolutely necessary to the financial accounting and reporting process. Without them, many accounts will be understated and others will be overstated. For example, if we fail to record accrued revenues, both the assets and the revenues, and subsequently the net income, will be understated. Or if we fail to record depreciation expense during the period, assets will be overstated while expenses will be understated, i.e. be too low, thereby resulting in an overstatement of net income. In this section, we will learn the purpose of a worksheet and use it to prepare adjusting entries and the adjusted trial balance. A worksheet is a useful tool to aid in preparing the adjusted trial balance. The worksheet provides columns for the unadjusted trial balance, the adjusting entries, and the adjusted trial balance. The worksheet is an internal document and is often prepared in Microsoft Excel. Exhibit 3.7 is an example of a partially completed worksheet. This worksheet will be completed in Chapter 4. In this chapter, we will complete a part of the worksheet. For now, we will concern ourselves with the first 4 sections. Section 1, Account Names. The account names are taken from and listed in the same order as the chart of accounts. Cash first, accounts receivable second, and so on. Section 2, Unadjusted Trial Balance. The account balances are copied directly from the ledger before any adjustments. Total debits must equal total credits. Section 3, Adjustments. Enter the adjusting journal entries that were made on December 31. Section 4, Adjusted Trial Balance. Gives the account balances after adjustments. Each amount in these columns is computed by combining the unadjusted trial balance amounts plus or minus the adjustments. After the last section, you should understand the alternative treatment of recording deferred expenses and deferred revenues. The nature of most deferred expenses is that they have very short lives and will expire in the current accounting period. Therefore, the accountant may decide to record the expense rather than create a prepaid account. At the end of the period, adjustments are made if the full amount did not expire during the accounting period. In this example, the full 3 months of rent was recorded as an expense instead of as an asset. Deferring an expense creates an asset. However, the asset may be so short-lived that it will expire in the current accounting period within 1 year or less. Thus, the accountant may decide to debit the prepayment to an expense account at the time of payment. The entry could alternatively be recorded as a debit to rent expense and a credit to cash. As of December 31, only 1 month's prepayment has expired, leaving 2 months of rent still prepaid. In this case, the accountant must transfer 2/3 of the original prepayment of $3,000 or $2,000 to the asset account, prepaid rent, with an adjusting entry. At December 31, the $3,000 prepayment is correctly divided as $2,000 of prepaid rent and $1,000 of rent expense, regardless of whether the business initially debits the prepayment to an asset or to an expense account. The nature of most deferred revenues is that they have very short lives and are expected to be earned in the accounting period. Therefore, the accountant may record the entire amount as revenue instead of using the unearned revenue account. An adjustment will be made at the end of the accounting period if any of the service revenue has not yet been earned. Another way to account for the receipt of cash is to credit a revenue account when the business receives cash. If the business then earns all of the revenue within the same accounting period, no adjusting entry is needed at the end. However, if the business earns only part of the revenue in that period, it must make an adjusting entry. In our example, Smart Touch Learning has earned only 1/3 of the $600 or $200 by December 31. Accordingly, Smart Touch Learning must make an adjusting entry to transfer the unearned portion, 2/3 of $600 or $400, from the revenue account to a liability. The adjusting entry transfers the unearned portion of service revenue to the liability account because Smart Touch Learning still owes e-learning services next year. After posting, the total amount, $600, is properly divided between the liability account, $400, and the revenue account, $200. At December 31, the $600 cash receipt is correctly divided. $400 of unearned revenue and $200 of service revenue, regardless of whether the business initially credits the cash receipt to a liability or to a revenue account. This is the conclusion of the presentation on Chapter 3.